Hello again, this is Mark. Welcome back to Top Business, everyone. In today's video, we're going to discuss 10 different methods to value real estate. If you're not subscribed yet, you're missing out on some great content. Please be sure to hit the bell icon to be notified when a new video drops. Whether your goal is to eventually purchase your own property, or if you're already a homeowner, or if your passion is to become a real estate investing mogul, real estate decisions are some of the largest that we can make in our lives. That's because for the majority of people, the largest financial transactions we call home are for the ones we're going to rent out to tenants. And that's why it's extremely vital to know how to make the right choices when it comes to real estate. If you're not subscribed yet, you're missing out on some great content, so please hit the bell icon to be notified when a new video drops. So let's get started increasing our real estate aptitude and get right into this list with 10 different methods to value real estate. Number 1. Compare the price of similar listings. That's right, you might have thought analyzing real estate was going to be super difficult like quantum physics. Well, the most common method is very easy, and it's something you already do when you're purchasing daily incidentals from hunting for deals online to airline tickets. You compare what you want to buy or sell with something similar on the market. With real estate, similar means a property that's sold in the last 3 to 6 months, and that's about the same square footage as the property you're evaluating, and with the same number of bedrooms with similar amenities and the same condition. And most importantly, the same neighborhood. If you want to buy or sell a property and you want to know the value, look for a similar property that's sold recently. This will give you a really good estimate. Number 2, take into account differences that you can quantify. How am I going to find a listing that's exactly the same as the property I want, or the one I'm trying to dispose of? If you're about to ask this question, then you're correct. That's why number 1 is generally just the first step. Then you have to analyze the differences that you can then quantify. But what do we mean by differences that you can quantify? For example, let's say you're in the market to purchase or sell a property. Let's label it Property A, and a similar property in the same neighborhood sold the previous month for $500,000. We can call that listing Property B. Property A requires structural repairs. However, Property B was in mint condition. Here, analyzing the differences is simple. You should inquire to home builder or contractor to give you a quote for repairs on Property A, so it's in the same condition as Property B. Then subtract that figure from the price that Property B sold for. And with that calculation, you have an approximate market value for Property A. The inverse is true as well. Hypothetically, Property A is better than Property B, maybe because it's got a stunning gourmet kitchen. Calculate how much it would cost to have a gourmet kitchen installed in Property B. Add that cost to the price Property B sold for. With that data, you've got the fair market value for Property A. Number 3, and try to calculate in differences you can't quantify as well. There are features that are simple to put a price on, like an upgraded bathroom, a stunning chef's kitchen, or repairs that need immediate attention. But what about differences that you can't analyze easily? Items on the bright side could be its walking distance to a major employment center, such as a downtown, or has a stunning view. Or on the other hand, the property could be next to a busy freeway. Well, you can quantify how these will affect the value of the property, and having experience is key. A novice in real estate won't be able to quantify how much value will be added to a property if it's near a major employment hub, such as a downtown business district. There is no equation for it because it's going to vary from place to place, because real estate is localized. But for an individual who's always up to date on local real estate news and trends, being aware about what variables are pushing prices up or down, especially, it will lead to an experience and intuition. And they'll be able to make a good analysis of intangible items. Number 4, if you're purchasing to invest, calculate if it's worth the money. Imagine this. Let's say looking to purchase an apartment you want to rent out. You must calculate if it's worth the trouble, or if you can do better with similar properties in the vicinity. You might ask, how do you accomplish this? The first thing you want to do is to find 2 figures. The first figure is the amount of revenue you'll need to earn from the property in 12 months. If it's presently being leased by the present owner, you can inquire are the total rent rolls. If you don't have that data, compare with similar properties in the vicinity, subtract maintenance expenses and property taxes, and the remaining amount is called net operating income, or NOI. In other words, that's the figure you can expect to collect in rent in the span of 12 months. For example, you've calculated it at $35,000 a a year for the building you're potentially purchasing. What you need to keep in mind is the capitalization rate or CAP rate. The CAP rate is the percentage of what you'll pay to purchase the building that you can expect to earn in 12 months from rental revenue. You can find this data from local realtors. They can tell you the average CAP rate in your local market. For this example, the average rate is 7%. So, in review, you can earn $35,000 in 12 months, and the average return on investment per year in your market is 7%. That means that $35,000 is 7% of the price it's valued for you to pay for the listing. How's your arithmetic skills? Have you calculated the answer? If you ended up at $500,000 as the value of the property, then you got it correct. $500,000 is the price the listing is valued at if you're planning to purchase this particular property. Now, if the list price is higher than that, you should look for another listing because opportunities appear every day. Now, if the asking price is less, it looks like you found yourself a good deal. Number 5. Calculate the cost to build it from the ground up. Professionals in the real estate industry call this tactic replacement approach or the cost approach. And it's exactly what it sounds like. If the infrastructure disappeared overnight, what is the cost to rebuild it from the ground up? First, you must know the value of the land atop of which the structure will stand. Then determine the cost to erect another structure on the site, including the price of materials and labor. Tweak them down for aging and damage, and you have your total price. Real estate professionals use this method to determine the value of structures that don't usually sell on the market. Examples are schools, hospitals, or government buildings. It's based on the theory that a practical buyer wouldn't spend more for listing than what it would cost to purchase the land and construct it themselves. Number 6. Consult a real estate professional. Is it all getting a bit convoluted? Of course, you could just call a competent realtor. Keyword is competent. A true real estate professional should be able to make the complicated calculations, but you should still know how to do the calculations yourself to verify their analysis in congruence with your objectives. There are a few drawbacks to realtors. First, if you're planning on selling your property, don't just trust what the realtor says. Do your own due diligence first and verify all the information that is being conveyed. Tools such as Redfin, Zillow, and Realtor.com are great tools for the consumer. If need be, it's always best to get a second opinion before choosing the professional to list your property. It's well known there are dishonest realtors who will often inflate the value of properties because they want to convince the property owner to put it on the market with them and not with the competition. In reality, don't realistically expect to receive the asking price they listed it for, and their agenda is to drop the price after the property has sat on the market. Remember, free market dictates the price of the property. The law of supply and demand is always in play. Conversely, if you're the buyer, don't trust what realtors tell you, either because there's a high probability the price they're requesting for is significantly higher than what it's worth. Bear in mind, realtors aren't obliged to give accurate price to a buyer or to a seller. They're a salesperson, not an economist. If their analysis turns out to be incorrect, you cannot take them to court. We're not saying all realtors are bad, we're saying buyer beware. Number 7. Consult a real estate appraiser. If I scared you with the reality of realtors, what real estate professionals should you trust? Well, the best chance is a competent real estate appraiser. Again, keyword being competent. The drawback is it'll cost several $100s, but it's money well spent for peace of mind. In the United States, it's standard practice to have an appraisal before the closing of a property, as it's a requirement for most banks issuing a mortgage. Real estate appraisers must be highly qualified and follow stringent procedures and show they are completely unbiased towards the buyer or the seller. Second, they have access to an extensive database of property sales the realtor doesn't have access to, which is used to value the property. Third, they can discover hidden issues with the property that the real estate salesperson is probably ignorant about because they're more thorough. Of course, getting an appraisal will cost several $100s, but if you're about to purchase a property for $500,000, it's a no-brainer. Number 8. Ask a property valuation website. The wonders of technology, a website that does this property analysis for you. Many people do this, but it's definitely not the best method. Yes, computer algorithms are more and more advanced today, but evaluating real estate is one skill you're not a pro at. These websites are great tools, but they don't take into account all variables such as condition of the property. Unfortunately, there's no public record for these items, which means the computer has no way of factoring in these variables into the algorithm. Besides, when algorithms use local properties that sales as as a baseline, there's variables that algorithms can't calculate, but that humans would see intuitively, like when there's an affluent neighborhood close up to a poor one. Anyone driving through would notice the differences in a second, but the algorithm just sees them as being in close proximity to each other, and so prices appear to be the same. That's why it's important to do your due diligence and actually visit the neighborhood to get the vibe. Number 9. Listen to macroeconomics. The value of the property basically means the price the buyer is willing to purchase it for and what the seller is willing to let it go for. That means if you're selling and you're unsure of what the value is, you can just listen to what the market dynamics are. Is it a buyer's market or seller's market? If you list property at a certain price and nobody gives an offer, that likely means it's overpriced and you need to lower the price. But when you get multiple offers that day you list it, it means buyers are too motivated and it's probably underpriced. If that happens, raise the price and see if the buyers start to outbid each other. Number 10. Capitalize on the fact that people don't know the market. This one is not really about valuing the property. It's about earning cash from it and how flippers make big bucks when they buy, renovate, and resell. Remember, when we discussed making changes to properties? In a nutshell, what we discussed about is the following equation. Market value of the property before renovations plus cost of renovations equals after repair value, better known as ARV. But what would that signify for house flippers? Something like this. Investor purchases a property for $175,000, invests $50,000 renovating it and sells it for $350,000. Simple, right? First, the investor knows the neighborhood better than most people. They buy an ugly house and somebody who lets their property become rundown, probably ignorant about the market and just wants to get rid of it. So the investor buys the property that's worth $200,000 for $175,000. Now the investor spends $50,000 renovating it, and they do such a great job that buyers are head over heels at first sight. Yep, investors know a thing or two about finishes as well. This creates an emotional connection with the buyer, which means the buyer is less likely to make a rational market-based decision. Combine that with the investor's power of persuasion, and the property sells not for its market value of $325,000, but for a cool $350,000. Shall we recap the data? The investor purchases the property for $175,000, spends $50,000 renovating it, and in total it costs $225,000, and the house flipper sells it for $350,000. That's a tidy $125,000 profit. It came from the flipper being knowledgeable about the market and the fact that other people liked the original seller and the final buyer did not. What's your opinion on the most exciting thing about real estate? Let us know your thoughts in the comment section. And of course, for sticking until the end, here's your bonus. Develop your real estate intelligence. We understand we discussed many items in this video. You'll want to be implementing them when you're in the market to buy and sell, and that sounds easy enough. But unlike calculating how much a stunning ocean view is going to add to the value of a property, or how much a busy freeway is going to take off of it. Just like with stocks, if you're looking into it for the first time, it is complicated. But dedicate some time each week to follow stocks, and you'll develop the knowledge and eventually the intuition that will make you successful. It's the same with real estate. At first, there are questions you have no idea how to answer, but follow real estate trends in your local market, read books about the theory, and eventually, you'll go from being ignorant to having your finger on the pulse when it comes to real estate. And that means you've raised your real estate aptitude. You can talk about it with competence, and when it comes to making any kind of real estate decision, you are primed for success. If you would like to know more about becoming educated on becoming a real estate investor, particularly in flipping houses, directly message Novum Imperium on Instagram for details on how to enroll on courses on flipping houses. The instructor will go over everything so you can be on your way to becoming a real estate investing mogul. A link will be in the description below. On the off chance you folks have liked this video, give it a thumbs up, and if you want to see more of this content, click the subscribe button and the bell icon to be notified when new videos drop. It takes a lot of time, research, passion to create great content. If you like my work, please support me on Patreon at patreon.com/topbusiness. The link will be in the description below. Tune in next time when Joe will be discussing 5 ways to earn money online while the globe is in lockdown.